Hello. Young Jae Lee and myself, Mark Bolton, are delighted to be in Tokyo. We are two members of a team of five that works within the emerging market equity team. The other members involved in the strategy are Chris Bannon, Chris Hartkoff, and Tan Altudag.
Emerging market outperformed developed market from 2000 to 2010. However, it started to underperform from 2010 for past 12 years. However, the good news is we're seeing leading indicators are turning around. The two leading indicators that we are seeing is number one, GDP gap between emerging market and developed market. Number two is US dollar index. GDP gap between emerging market and developed market has a strong positive correlations, which is turning around, and then we believe it will go back to normal level of 3% difference within the next few years, and we're at an inflection point. And when we look at the US dollar index, it is also showing a strong correlation, but in a negative way. And this, we believe US dollar has picked, and then along with the upcoming Fed rate pause or rate cut cycle, it may start get weakening, and which will further boost the emerging market turnaround. Therefore, we believe the emerging market is at an inflection point, and it is time to look at emerging market. And when we also look at the currency by itself, US dollar is currently trading at more than one standard deviation above its historical average. On the other hand, emerging market currencies altogether currently trading at two standard deviations below its historical average. Therefore, we think US dollar itself is right now very expensive. On the other hand, emerging market currencies are cheap. And when we also look at the market valuation, after 12 years of outperformance, developed market currently trading at 0.5 standard deviation above its historical average. On the other hand, emerging market overall trading at one standard deviation below its historical average. So putting things together, the developed market currencies are expensive and developed market valuations are expensive. On the other hand, market valuation for emerging market and currencies are all cheap.
Yes, in terms of valuation, on the cyclically adjusted PE basis, emerging markets relative to their own history have only been cheaper for 4% of their history in terms of cyclically adjusted PE. So they're incredibly cheap on a PE basis relative to their history. And if you look at dividend yield, which is one of the key pillars of value that we focus on in the high dividend fund, emerging market dividend yield is trading two standard deviations cheap relative to its own history. The final point I wanted to make on emerging market equities is one that's connected with the interest rate cycle. So historically, the Fed and global developed central banks have always moved first in the interest rate cycle. This time round, the Fed was effectively late, didn't want to start raising rates until it was convinced that they had an inflation problem. And actually this time round, Brazil, Mexico, and Korea all started to raise rates, interest rates, before the Federal Reserve. So almost for the first time in history, this rate cycle, you have seen emerging central banks being early. I think Brazil was 12 months before the Fed almost. You see interest rates being raised by emerging market central banks, which means now the cutting cycle, as inflation decreases, the cutting cycle for emerging market central banks is happening before the Fed. This time around in the cycle, we are seeing emerging market central banks cutting before the Fed, which is almost unprecedented. The Fed is probably expected to pause until July 2024, possibly longer. And in that time, we believe we will see central banks cutting rates in emerging markets in the likes of China, Chile, Poland, Brazil, Mexico, India, Korea, Philippines, and Taiwan. So the whole interest rate cycle in emerging market equities is far ahead of the Fed and developed market equities. Equity markets tend to follow interest rate cuts. As the interest rate cycle starts to be cut, equity markets tend to rally, and we expect that that will be the case this time round. A final reason why emerging market central banks can cut before the Fed this time is that sort of metrics such as current account balances within emerging markets are far, far stronger this time round than the last cutting rate cycle. So countries can afford to start cutting their rates before the Fed because they know that their external imbalances are less and there is less pressure likely to come on the currencies in their countries if they start widening the gap with the Federal Reserve rates. As I said in answering the previous question, the interest rate cycle in terms of rising interest rates is far more advanced in the emerging market world than the developed world. So some of the problems that you might have seen from that hike in interest rates, we should have started to see already. Indeed, we are now at the position that interest rates are being cut and cut quite fast in emerging market countries. There haven't been any major problems in terms of debt defaults, apart from some countries like Sri Lanka and Ghana, which are really frontier or even below frontier markets from an equity investor's perspective, and which are markets that the Emerging Market High Dividend Fund and the Global Growing Market Fund are not exposed to. So we don't foresee any huge problem on a sovereign level. Indeed, probably the whole emerging market world in terms of sovereigns and corporates is far better placed this time round to withstand the hiking interest rate cycle. As I said, current account deficits, external balances are much better. And it's amazing to us, for example, to see how Indonesia, which was one of the fragile five, used to be called, has really thrived during the period of rising rates. The only two areas that there is perhaps some concern with would be Argentinian sovereign debt. They have a dollar position in Argentinian sovereign debt. We don't have any direct exposure to Argentina in either fund at the moment. And the second area is probably Turkish corporate debt, where there is a certain amount of dollar debt still on Turkish corporates' balance sheets, and we have very limited exposure to Turkey. So overall, we don't actually see a problem per se from the rising interest rate cycle that we've had in emerging market equities. What we would look for actually is perhaps some development of issues in some of the developed market countries. One area that we are watching closely kind of on a global scale is the smaller and mid companies in the United States who were used to paying interest rates of 3 or 4% 2 years ago and are now having to pay interest rates of 6, 7, 8%. And I think that could be an area that we need to watch, although overall credit spreads have been very well behaved in developed markets too.
Labor growth or working population growth is one of the key factors for the GDP growth model, and that's why we're focusing on working population growth for our GGM fund. And the working population actually has the biggest explanation power for emerging market GDP forecast. And within our GGM fund, our key focusing countries include India, South Africa, Mexico, and Brazil, and also some of the ASEAN countries. And India is among those one of the most interesting structural growth story that is mainly because of the favorable demographics. Indian population's median age is less than 30 years old, and they are highly educated, government policies are very supportive, and there are many high-quality companies. Indian economy is growing about 6% per year with the rear term, and Indian economy is likely to be third largest economy in the world before the end of this decade.
So Young Jae has talked about India as a very interesting market in the Global Growing Market Fund. We have about 20% weighting there. Other really interesting countries within that fund would be somewhere like Mexico, which has about a 15% weight, just a tremendous beneficiary of the nearshoring theme, effectively, which amongst a generally very strong economy is driving earnings in Mexico. So earnings were projected to grow at 4% in March of this year for the whole year of 2023. Now we're in October, they're going to grow at 14%, and you're seeing continual upgrades in Mexican corporate earnings, partly because of that nearshoring trend. One other country that's particularly interesting is Brazil. Again, I think that's about an 18% weight in the GGM fund, and also both of these countries are overweight in emerging market high dividend yield. Brazil has interest rates at 12% at the moment. Inflation is about 4 or 5%. Highest real interest rates probably in the world. And in Brazil, what always happens is there's a massive switch from the domestic investor, who currently can earn about 1% a month on their fixed income investment. When interest rates come down, there's a huge switch into the equity market. And the equity market is trading at historically very, very cheap levels of around seven times PE. Those are just two other markets with growing working populations that we think have very strong backing in the GGM fund. So safe is an interesting word, I would say. We don't think there will be a crisis, a real financial crisis, following the Chinese property slump in China. Number of reasons for that. The first is, and maybe it's a little bit different from Japan, we think as well it may not take a decade effectively to recover from the property decline in China, mainly because it's a centrally planned economy, and it's far easier to enact policies quickly to avert disaster in a centrally planned economy. That would be one reason. The other reason is that actually something like the Chinese consumer in China saved about 4% of GDP during COVID, and that's just sitting in their deposit accounts at the moment. So there are areas within the Chinese market that have plenty of liquidity and plenty of cash. The other side of it is, there's no property tax at all in China at the moment. You don't pay any tax on property transactions or holding property in China at the moment. So the government further down the line has revenue raising capabilities if it needs them. What we do feel is that the property situation in China is really affecting the feel-good factor in China. So Chinese consumers who have that money in their accounts are not spending and are not going out to spend, which is why the sort of pickup from post-COVID has been disappointing. And we think this lack of a feel-good factor will mean that the recovery in China continues to be quite modest and quite slow. But we don't see that there will be big headline bankruptcies, possibly like Countrywide, but we don't see a kind of systemic problem in the financial markets stemming from that. We think that's unlikely. In terms of fund holdings, on the banking side in the high yield fund, we have some exposure to Chinese banks, but they are basically the top 4 Chinese state banks, which are very safe, and interestingly enough, continue paying dividends right the way throughout COVID, when European banks and US banks stopped their dividends. So the world was turned on its head, and China continued to pay investors while the US and European banks did not. So we think the state banks remain safe, and we own one Chinese private bank, which is the best of the bunch, China Merchants Bank. We have small exposure to some state-owned property companies, and there's been this massive shift from private developers to state-owned developers. And actually, the state-owned developers are doing relatively well. It's what Xi wants, to destroy the kind of model that made some Chinese private property entrepreneurs very rich, and the earnings and the profits have now moved to the state sector. So overall, we think the property situation will be a dampener to the Chinese economy overall, but we think it's unlikely to be allowed to spill into a crisis. So that's quite interesting. I think to deal with BRICS Plus first. BRICS Plus kind of is an interesting grouping. One of the themes that we have in both funds, the high yield and the Global Growing Markets Fund, is a thesis that oil prices stay higher for longer. So I think, and that's a result of underinvestment over the last 5 or 6 years, in part because of the green agenda and ESG and banks limiting credit to investment in upstream oil and gas, in part due to just the continuing increase of fossil fuel usage in the likes of China and India. And we think there'll be this gap between when fossil fuels are able to be phased out and renewable energy can take off. And in that gap, we see oil prices in particular and gas prices staying higher for longer. The BRICS Plus grouping, I think, controls something like 46% of global oil or global energy supply now. Saudi Arabia has come into BRICS Plus. So that's a very powerful bloc, effectively, and one that we think will, a kind of cartel that will keep oil prices kind of higher for longer. Turning to the global south, and indeed many of the countries in both of those designations are represented in the Global Growing Market Fund, with China not being there is the main exception, effectively, because it doesn't have a growing working population. But the global south, for me, is a bit more of a vague term, and has a bit more political connotations, and often includes China in terms of the global south. And we're seeing the geopolitical, standoff between the West and China at the moment. I suppose in terms of the global south as a collection of countries, I think that political tension, if China is included in global south, will also be there. The global south also seems to include countries, such as Pakistan sometimes. So it's a much wider grouping than our working capital, than our working population definition, which is just a very clean, empirical cut in terms of which countries we invest in and which we don't. One final point that we haven't mentioned is our team we're value investors, basically. So in both funds, what we're seeking to do is find cheap companies that are undergoing positive change, effectively. And value has been a very unloved part of the world if you're an investor over the last 10 years. But we feel with inflation staying higher and interest rates probably being higher as well, that value investing should be profitable for investors over the next 5 years. So both the Global High Yield Fund and the Global Growing Market Fund, with a value approach, we feel should do well.